Welcome to our Investment for All podcast. Our goal is to help our audiences in learning the economics and finance principles and how to apply them in the real world through in-depth discussions. Today, our podcast will discuss the economy and market outlook in 2023.
Thanks for our subscribers, and your support really motivates us to continue our efforts in helping the communities. David, the big debate today is whether our economy will have a hard landing or a soft landing. Some economists suggest that we might not even have a recession this year. However, my view is that we will definitely have a recession. In our last podcast, David and I discussed why the inflation will be more sticky and last longer than most people expected. I think the Fed will raise interest rates until the economy enters recession and economic activity slow down. We need to see the unemployment rate increase in order for wages to come down and inflation to drop. This is unfortunate for a lot of people and families who might lose their jobs during this recession. Remember to watch our future podcasts for updates.
I think we should provide more discussions this year about how to make money even without a paycheck during economic downturns. Many families might lose their jobs sometime this year. We will also use our donations to help communities who might suffer from this economic downturn. Write to us if you need our help. Back to our topic today. I agree with Edric that we will see a recession this year. Most people expect a soft landing, which means the quarterly GDP might fall slightly in the second half of this year, and the economy will reset to resume growth for a short period of recession. The stock market might already price the soft landing in 2022. I think it is hard to call it a soft landing right now, as big corporations just started layoffs and we are still having the Russian-Ukraine war.
David, the US stock market had a big pullback in 2022. A lot of famous long-only funds and hedge funds lost 30% of assets in 2022. If you look at FANGs, such as Meta, Microsoft, Apple, Google, they have all lost over 30% in stock price. Tesla has been free falling all of last year. Let me explain to our audience the relationship between Fed policy, interest rate, yield rate, and stock market. Basically, when we raise the interest rate, the 10-year bond yield rate will go higher, and thus money will flow into the bond market from the stock market. The stock market will fall as a result, and valuation will drop, especially for high multiple stocks such as software and life science stocks.
A pullback in 2022 would be a good setup for the stock market in 2023. I think the stock market will become more interesting again. In the December of 2022, there were more sellers and very few buyers in front of the expected turbulence in January, when the earnings outlook was expected to reset and more clarity of inflation trend came out. The broad-based sell-off in equity markets in 2022 has left some stocks with strong earnings potential for the long-term trading at very low valuations.
I agree. I would recommend people to look at the stock market, as many people are focusing on the bond market as of now. The market is currently too pessimistic about the stock market. I bet most investors are not fully invested, and we may not be confident on what will happen in 2023. Like Buffett said, investors need to be fearful when others are greedy, and greedy when others are fearful. David, have you seen the housing market recently? Are there any investment opportunities that have opened up lately?
The housing market is also a tough market in 2023. Materially higher new mortgage rates are crimping new house demand, and I think the ripples of weaker housing activity will permeate through the global economy in 2023. Construction will weaken, spending on furniture and other household durables will fall, and falling housing prices could weigh on consumer spending for the next few quarters. This might be good for the deflationary process, as shelter cost is a big part of CPI, that the weakening housing market will hit the economy hard.
I don't think we are going to see a correction to the housing market like we experienced in 2008. First, housing construction was relatively subdued for much of the last decade, which means we are unlikely to see a glut of oversupplying driving house prices materially lower. Second, those that have recently bought at higher prices were still constrained by the bank's more stringent loan-to-value and loan-to-income ratios. In addition, many people are expecting the Fed to lower interest rates in 2024, so home buyers could refinance with lower mortgage rates. Talking about Fed pivot, David, there's also a debate when the Fed will pause the interest rate increase. What do you think about this?
There could be a scenario that the inflation panic subsides when the central banks pause in the second half of 2023, but we would have to see an economic recession first. If the quarter 3 GDP growth is negative in 2023 and we have another GDP negative growth in quarter 4, then I think the Fed might start considering a pause or even cut the rate. Signs of slowing activity in the West and a return to full production in China should ease inflation through the course of 2023, with shrinking contributions from energy and goods sectors helping the price pressures to moderate in the months ahead. However, to be sure that we're out of the inflationary woods, wage pressures also need to ease.
Yes, this is where the Fed went wrong in 2021 and 2022 in assuming inflation would prove transitory, as they underestimated the extent to which the labor market tightness would result in workers asking for more pay. The layoffs in the high-tech space are likely to expand to other industries. Finally, it will hit the restaurant and leisure industry, where currently the most labor shortage is present. I feel the longer the interest rate remains above 5%, the more likely we will see a hard landing for the US economy in 2023.
I think there will be a recession even though PCE inflation will slow down. Ultimately, that's the Fed's goal, to weaken activity that leads to reduced inflation pressure. In the later months of 2022, many investors mistakenly believed that the Fed would pause, so as long as inflation is headed in the right direction. Our view is that it is likely to take more than 1 year to combat inflation, and the inflation will not be heading back quickly to 2%.
It is very likely that the US economy has returned to a 1970s inflation problem, which will require a much deeper recession and much larger rise in unemployment than we expect to drive inflation away. In addition, the moderate recessions are difficult to engineer because slowdowns take on a life of their own with a tendency to spiral. This situation has been true in the past when deep recessions were busts that followed the boom. Following excessive growth in one area of the economy, most commonly business investments or housing, often taken a long time for the economy to adjust and find alternative sources of growth.
During this big, uncertain time, what should our audience do? What if you lose the job? How do you navigate through this economic downturn? I think we should provide some ideas to our audience for potential investment opportunities in 2023. Please come back to watch our next podcast of big ideas of investing in 2023. Thanks for watching and supporting our Investment for All programs.